Morning again, everyone. Thanks a million for coming to the seminar and the webinar this morning on understanding defined benefit schemes. I suppose one of the things that we're seeing quite a lot of at the moment is a number of people who have older defined benefit schemes who are looking for a little bit of information in relation to the benefits that they have under those schemes and how best they can utilize those benefits. So just before I kind of cover just a little bit about who we are, there is a Q&A section or a chat box on your screen. So if you do have any questions, please put your questions up there and we'll deal with them at the end, if that's okay with everyone. So I'm joined this morning by Tracy, our Senior Financial Advisor here at Oaktree. So Tracy has been with us for the last couple of years and has spent a number of years in both Ireland and in overseas financial services. So she's actually going to be able to give us a rundown on defined benefits this morning. For those of you who don't know who we are, Oaktree Financial Services, we're based here in Fermoy. We started in business over 10 years ago. My own history is that I'm an accountant and tax advisor as well, so I've qualified in both of those, and just felt that there was a lack of peer financial services advice available in Ireland, in our local area. So we set up Oaktree and started developing on that basis. Since then, we've over 1,500 clients. We've over 20 million in assets under management, and that has actually, even in the last couple of weeks, changed again. And there are 7 of us here in the office. So what we do is we provide advice in relation to pensions, investment, general financial services planning, and mortgages. So we deal with a lot of the leading life companies in Ireland, and we also use alternative investment managers as well, all the while ensuring that we get the best possible solution for our clients. Over the years, we have been awarded a number of distinctions, most notably the All-Ireland All-Star Awards in Personal Finance for 2018 and 19, and 19 and 20. As we said, there's a huge amount of, I suppose, misinformation out there in relation to defined benefit schemes. And what we've seen a lot in the last couple of years is a lot of these schemes transferring, and maybe some people not understanding the benefits of doing those transfers. So that was why we decided we'd run this seminar this morning. So with that, I'll hand it over to Tracy. And if anyone has any questions, please do remember there is a Q&A and chat box at the bottom. Put up your questions there and we'll deal with them as much as possible at the end. Tracy, it's all yours.
That's great. Thanks, Adrian, and a very good morning to everybody today. I hope you can all hear me. I know my screen is a little bit dark, so yeah, that's okay. It's more important that you look at the topics than my background. So today we're going to do a very generic presentation on defined benefit schemes. Every scheme is different, and obviously individual circumstances are so different as well. So this presentation will never be a one-size-fits-all. So obviously each person needs to take in their own individual factors into consideration when it comes to this particular topic. It is going to be a very informal talk. I guess it's probably going to be maybe 20-25 minutes to go through. I probably have about 18 slides. We do, as Adrian mentioned, we do have a question and answers section at the very end, but obviously as we're going through the different areas, if there's something specific, there is a question and answers box. If you go to that and just type in your question, and we'll happily get to it at the end of the presentation. So the topics we're going to cover today is what exactly is a defined benefit scheme, what past schemes were like versus what current schemes look like today, the advantages to remain within a scheme, and also the advantages to transfer out. DB schemes versus personal arrangements, and what available options you have to choose from depending on certain circumstances. Should you decide to take further action, basically we'll talk you through what the next steps would be, and then of course we will go through the questions and answers. So what is a defined benefit scheme? So a scheme really is a pension that's provided by your employer and is there and designed to pay an employee a promised level of income once they reach their retirement. Now that income level is predetermined by the years of service an individual has and the earnings at the time that they depart the employment. These schemes are typically managed and funded by the employer. There are scenarios where employees also contribute, but predominantly they're funded by employers. The benefits that are paid, there's two types of benefits that are paid from a DB scheme. The first would be your PCLS, which is your pension commencement lump sum. So that's your tax-free amount. And that would equate up to about 1.5 times final salary. Annual pension payments will come into about 2/3 of your final salary. Um, the benefits that are payable will be based on the members or the individual salary at the date that they leave the service, and the average salary over that employment. A lot of the schemes have switched from final salary to average salary. And naturally, it's always going to be dependent on the numbers of years service that you provided within that employment. So as I mentioned earlier, typically the scheme would be funded by the employer, but in certain circumstances and in certain schemes, employees can pay an element of contributions. Typically these schemes would be hybrid schemes. In addition to those type of contributions, any individual, that is in employment can also top up or contribute and make voluntary contributions into an AVC, basically to retirement benefits when you come to your normal retirement age. So over the years, DB schemes were always considered gold-plated. They were always the golden or the Rolls Royce of all. Back years ago, whoever was parting in a DB scheme would never consider to leave it because of that. They never considered to leave once they left the employment, because historically these schemes were like gold plated. The times we live in today, obviously everything has completely changed. In the first instance, we don't have a lot of individuals that would stay with one employer throughout their working career. So basically now what happens is, you have a lot of people that would switch from one employment to the other. But schemes these days, they're becoming under such pressure to keep to keep the scheme funded. The Pensions Authority, they're the authorities that manage the financial strength of funded DB schemes, and that's through the operations of the funding standard requirements under the Pensions Act. So companies need to maintain enough funds there to make sure that their members' entitlements within the scheme are honoured should the scheme have to be wound up. Typically, schemes will be very heavily reliant on performance of long-term bonds to future protect the entitlements. So naturally, when the performance of these bonds are decreased, most DB schemes will come under huge pressure to meet those obligations. We have a prime example of that with someone local to us here in Waterford, with Waterford Crystal. Another example will be the Irish News and Media, and that's where the employer decided not to continue to support the funding of the scheme. As Adrian mentioned, I've worked internationally for many years, so I would have had quite a number of years experience dealing with UK schemes as well. And there was none bigger than the British Steel and the Tata Steel scheme. Again, all because of underfunding issues. Basically, when interest rates reduce, funding becomes under increased pressure. British Gas is another big example there. So due to the stress and the underfunding of these schemes, A lot of employers had to find different ways that they could reduce their future liabilities. And that's where we've seen instances where employers will actually offer enhanced transfer values in order to offload their deferred members. Obviously, the more liabilities they have on their book, the more of a funding issue that they have. So they'd be keen to offload these members. Another way that they could reduce those liabilities is to change, and this is what we've seen in more recent years, where they've changed the assessment of or the qualifying final salary has been changed from the final salary date of leaving to a calculation method that it averages over the career of the individual during that employment. So again, that would reduce that liability that they would need to fund to meet the Pensions Authority's requirements. There is a misunderstanding there that these defined benefit schemes are guaranteed. This is a snippet that's taken directly from the Pensions Authority, and it confirms that the so-called promise payments, they may be reduced. So yeah, you can read that one for yourselves there. So when it comes to options, when you leave an employment, you either can become a deferred member of that scheme, and you have two options basically that will be available to you. You can remain a deferred member and receive the lump sum benefits and the annual benefits that's offered by the scheme, or indeed you can choose to transfer out to a personal arrangement. The transfer calculations is also known as a CETV, which is a cash equivalent transfer value. Now, transfer calculations are very complex. They are prepared by actuaries. The purpose of a transfer value is to ensure that the value offered would allow the member to purchase an annuity today that would be equal to the benefits that they'd be entitled to from the scheme. Of course, you do have, the scenario where they offer enhanced transfer values, and again, that's just to, to offload some of their future liabilities. But in essence, that's the purpose of a transfer value, to make sure that that member is not disadvantaged in any way, that the benefits that's provided by the scheme at the time of leaving can be equal. The lump sum can allow them to go out into the marketplace and purchase an annuity or provide them with a benefit that's as equal to the annual salary that the scheme would provide at normal retirement age. So these basically are the available options. Now there's quite a lot of details on this. So basically you can remain in the scheme and accept the payment provisions that are allocated and ring-fenced for you at normal retirement age. You can transfer to a defined contribution scheme. Now, typically this would only be available for current employees. So this wouldn't be if you're necessarily leaving employment. This would be if a company decided to close down a DB scheme, but still they provide a defined contribution scheme so that members can continue to contribute into their own scheme. And of course, then you have the option to transfer out into a personal arrangement. Now, usually this would only be available for deferred members. So the little, I don't know, picture graph there, that basically explains the process. So you'd have the transfer value payable from a scheme. For example, let's say that's 120,000. If you were lucky enough to receive a company enhancement of say 30,000, both of those combined would be the equivalent of your transfer value. So you would take that and you would go into the marketplace, and again, you can either take it into a personal arrangement or you could purchase an annuity with it. And the other option, of course, is instead of going the personal route, is to remain in the scheme and accept the payment, the annual payment or the annual income that the scheme will pay at the normal retirement age. So I've mentioned the enhanced transfer values. Schemes would offer these bonuses or enhancements to encourage members to transfer out of the scheme. The reasons why they do that basically is, when the scheme becomes under pressure. They need to reduce the future commitments of the scheme. The reasons a scheme would become underfunded would be possibly because of investment selections. Performance wouldn't be what they anticipated to be. It would be very much reliant on market performances. Mortality rates is another reason. We're all living longer now. Obviously, the longer we live, the more strain that's put on these schemes because they have to pay the annual benefits for over a longer period of time. Sometimes there is issues with companies' profitabilities. So in that scenario, obviously the company wouldn't like to use its own capital reserves to cover the members' future entitlements. And basically, for the enhanced transfer values, they're offloading their future liabilities, just basically to encourage members to transfer out. Now, in some instances where funding is particularly bad, the enhanced transfer values may not be put on the table for consideration. Sorry, just one point on that last slide is that transfer values can be offered to both past and current members. So, like for example, Aer Lingus offered enhancement to a lot of their members to encourage them to switch over into their new defined contribution scheme. So the advantages that an individual has to remain within a DB scheme would be the longevity risk, so that for no matter how many number of years you survive beyond your retirement date, you will have a set income payable to you. It is a perceived promise of an income for life. You will, no matter what, or your spouse will, no matter what, receive the spousal death benefit in the event of your departure. Now, unfortunately, that wouldn't be 100% of your annual benefit. It would, in normal circumstances, equate to about 50%. It's very, very rare to find any scheme that will pay a spousal benefit that's above 50%. A lot of people as well, remain and consider it a big advantage because it's hassle-free. They don't need to do anything. They know that they've got that reliable set income being paid to them each and every time, and there's nothing more that they need to do. The advantages to transfer out, obviously, the first point being that everything is transferred into your own personal arrangements and that you get full control. You do get, because of that control, you get to target a specific growth level that would be more appropriate to your risk appetite. As an individual, you would have earlier access to a personal arrangement versus the defined benefit scheme, because in that instance, you could only access the benefit at the age the scheme dictates. The tax-free lump sum or the pension commencing lump sum can potentially be higher than the 1.5 times pensionable salary that the DB scheme would pay. When you transfer to your own personal arrangement, your spouse or your family get to receive 100% of the death benefit in the event of a premature death, versus naturally the 50% spousal benefit that you'd obtain with the DB scheme. And naturally, in certain cases, you can avail of a transfer value. Some schemes would offer enhanced transfer values at certain points to kind of offload a bulk of future commitments there. So normally when that happens, it's a very good idea to look at what the enhancement transfer values are and basically what difference or what it would mean to you and your family. You do, of course, have more peace of mind with the personal arrangements, because you don't have to worry about promised payments not being delivered. Again, if a scheme comes under funding, if if they cannot meet their responsibilities, then they can reduce the benefits payable to the employees. So again, that's a fear that you don't have to worry about, and insolvency doesn't come into the equation at all. So again, this is really a summary. So some of the key things to consider is that you would have potentially a higher tax efficient retirement lump sum. So that would be higher than the defined benefit. The 25% tax-free lump sum would be higher than the 1.5 times annual salary or average salary when you leave the DB scheme. You do have greater flexibility in how you draw down the retirement benefits. So basically, like, we would have a lot of members in retirement that would be taking advantage of their obviously the tax thresholds. So from the age of 65, an individual can actually earn up to 18,000 per annum. Anything over that, they're subject to income tax. So, for example, if the state pension, they'd get just over 12,500 if they're qualified for the full entitlement. Then they can use their personal arrangement to top up that level of income. But you can take as much or as little as you need. So they might decide to just top it up to their tax threshold of 18,000, so as not to be physically paying tax. Or alternatively, if they're still working part-time, they might decide to not draw anything that year if it's going to bring the income levels over the 18,000. So it just provides much more flexibility in what you decide and how you decide to draw it in. There is no guarantee that personal arrangements will deliver the same level of benefit at retirement as promised under the DB scheme. Obviously, yeah, with DC schemes, there is no guarantees. With the DB scheme, you will have an annual income that's set for the duration. Naturally, with the DB scheme, so there is no guarantee that the DB scheme will deliver the promised benefit because, again, of underfunding issues. So this is in summary of the comparisons. So the income in retirement on a DB scheme, it's promised income at normal retirement age of 60 or 65. That would be typical. Usually increasing each year in line with inflation. Compare that to a personal arrangement, you can obtain the flexible income from the age of 50. And you can tailor the drawdown to your individual income needs. You would do that by transferring it into an ARF or an AMARF. Now, I'm not going to go into too much detail with that, but basically an ARF or AMARF, if you have income of 12,700, everything can go into an ARF. If you don't have a guaranteed income, then 63,500 needs to be placed into an AMARF, which is a minimum retirement fund, and that basically is held in a separate fund until the age of 75, but you can draw 4% from that. The next section will be the PCLS, which is the pension commencement lump sum. Again, in a DB scheme, typically this would be 1.5 times your final salary, versus in a personal arrangement, you can have 25% of your fund value. In both cases, it's tax-free. The thing with the personal arrangement is obviously if you have 25% of the entire fund that you've grown, when you decide to start drawing on this and receive your tax-free lump sum. With the death benefits in a DB scheme, typically it will be 50% of the pension income that will be passed on to the spouse. And now, unfortunately, when a spouse would pass, the entire benefit would cease completely on that second death. Versus a personal arrangement, the full value of the remaining fund will be passed both to the spouse, and again, in the event of the spousal death, it will be passed into the estate. The next slide will cover a little bit more on that. And basically on the capital growth then, so With the DB scheme, you're being given an annual salary, so there are no capital or benefit, because the benefits are purely determined by the length of service and the final salary when you leave the scheme. They can, in most cases, the scheme would offer the benefit of increasing in line with inflation, so that obviously you keep your time value and money. Versus the personal arrangement, where value is invested, it will receive the capital growth and that will be in line with the investment performance. So again, your investment performance will be pretty much influenced by the length of time that you had before retirement, because the closer you are to retirement and drawing on this money, obviously the less risk you'd want to take with it. You'd still want some returns, but you wouldn't be overexposing yourself there. So that was that one. Taxation. On the DB scheme, the income that you receive, the annual income benefit that would be payable to you is taxed at your income rate, marginal rate of tax. On death of a DB scheme, your spouse would receive 50% of the annual pension, and that too would be taxed at marginal rate. There would be no beneficiaries in that if you decide to go that avenue. With the personal arrangement, the retirement income again is taxed at marginal rate, but again, you have the option to individually tailor the income drawdown that you take from the fund. On death, 100% of the value goes to your spouse. Obviously, when they decide to draw it, that will be taxed at their marginal rate of tax too. And then 100% in the event of your spousal death, there will be 100% payable to the beneficiaries. This slide basically is covering what happens if you do transfer out. So when you transfer out of a scheme, you're literally giving up your right to that income that the scheme would provide you. So you're waiving the right to the pension income provision as per the defined benefit statement. So once you leave an employer, or once you're considering drawing down from your scheme, you would be provided with a benefit of a statement of benefits. So that's where all these details will be provided. Should you transfer out, you're literally setting up a pension in your own name. You're ring fencing the value of that and taking control of it, and you're removing the employer's involvement. You're taking the transfer value plus any enhancements that you might be lucky enough to get into your own new personal pension arrangement. You take control of the future growth of that pension. And then, of course, at the end of retirement, you get to choose how you wish to draw it down. So what you need to do really is to understand what you're being asked to do or what options are being provided to you. Identify what's important. Everybody's circumstances are different, and your family circumstances will play a big part in what you decide to do. Whatever you do, seek as much information as you can so that you can make informed decisions. And as always, we would recommend that you seek professional advice from somebody like ourselves, from a broker that can give you the guidance that would be most appropriate to your personal circumstances. Now I know we kind of flew through a lot of that, but I hope there was it was clear enough. It's quite a complex topic, so it's very difficult to try and streamline things for you. But again, if you have questions, I know Adrian was the one that was monitoring all the questions coming in. So we'll hear from Adrian now, please. Hi, Adrian.
Well done, Tracy. Thank you very much for that. So there has been a couple of questions that have come in. One question there is does the transfer value change, and how is it calculated?
Okay. So yes, transfer values can fluctuate and it will be based on a few different factors. So interest rates and inflation would affect the transfer value. Sorry, Adrian, what was the second one?
Yeah, so how is the transfer value actually calculated?
Okay, so it's quite a complex calculation, but some of the main things that will be covered in it will be the age of the member, the normal retirement age of the scheme. You know, some are 65, some in rare occasions they can be 60. The cost of living has a big influence on it as well, and the life expectancy, because obviously as a nation, if we the longer we live, the more it's going to cost to provide that benefit. And of course then we have the interest rates. So don't forget, like with these transfer value, the sole purpose of it is to ensure that if you decide to transfer out, the lump sum that's being offered will be sufficient enough to be able to sustain an income level that's equal to that of what the scheme was offering. So in essence, you know, the age, the normal retirement age, the cost of living, the life expectancy, and the interest rates, they will be the factors that would come into that. I hope that helps.
Okay. Um, the other question then that was there is, do all schemes offer an enhanced transfer value?
Um, no, again, it's the enhanced transfer value would be from schemes who are keen to offload their future liabilities. So again, they're looking to rid of members from future responsibilities. So no, if you're being offered a transfer value, in most circumstances, it's for a limited period of time. So they'd stipulate the duration that offer is on the table.
Okay. Another question then that came in, and actually this is something that we only have seen in recent times, Tracy, was just in relation to the benefits under the defined benefit scheme. So are all benefits under defined benefit schemes similar? And what I'm kind of referring there to myself is actually the spousal benefit, where we've come across a number of cases in the last couple of years that don't actually have any spousal benefit in them at all.
Yes, unfortunately there are schemes that don't provide a spousal benefit. The thing with any additional benefit that schemes offer, it's an additional cost to the scheme. So that's obviously going to influence the annual benefit that will be paid to that individual. So the more benefits that, or options of benefits that you avail of, the lower the annual income you're likely to receive from the scheme. But no, it's not guaranteed that a spousal benefit will be made available in the event of a premature death, because we all want to live forever, don't we?
Yeah. Yeah. Another question that's just after coming in there, what are your options with the transfer value? So if you decide to actually take the transfer value from your defined benefit pension scheme, what are your options?
Well, okay, so when you're transferring out of a DB scheme, you basically would have two considerations. If you're going to a new employment, if that new employer had a company scheme, they may allow you transfer from your old company scheme into their new company scheme. I have to say it's very rare these days, because again, you know, people aren't interested in transferring in. Other than that, you're putting it into your own personal arrangement and you're taking control of it. So again, as the example on one of the slides there, if you had a value of 120 or 150, a transfer value of 120 or 150,000, it's then going into that's transferred from that scheme into your new personal arrangement, and you get to direct, you know, the future growth or investment strategy that you would employ for that fund. And that will be typically dependent on your appetite for risk, and obviously your tolerance for loss too, and how close you are to retirement, because investment time frame does play a little part in that too.
Okay. And I suppose one of the other things that you often see with that is you may have someone who was on a reasonably good salary, but when you take 1.5 times that, the value of your tax-free lump sum there's a big difference between that and 25% of your overall fund. And I suppose what, in terms of your defined benefit annual payment, there is a huge commutation in terms of taking that tax-free lump sum as well, Tracy.
Yes, absolutely. So you do, sorry, but I didn't cover that in the presentation. When you either leave service or whether you decide to start drawing benefits from your DB scheme, you do have the option to just retain the annual income from the scheme. And if you choose to take your tax-free lump sum, what that would do is it would actually reduce the level of income that's being provided to you, because they're commuting a portion of the annual benefit to provide you that tax-free lump sum. Versus on the DC scheme, you have so much more flexibility, because it's a flat 25% of the overall value of the fund. Now, again, if you have time, if you've a few years before your normal retirement date, you have the opportunity to actively manage the growth and the direction that the investment selection would take to deliver the best results without being overexposed on the risk side of things. And then, of course, you get the 25% of the overall value. So in that instance, yeah, more often than not, it's more beneficial to take a 25% from a lump sum than to commute part of your annual benefit to receive a tax-free element.
Okay. There's another 1 or 2 questions here. What happens to my defined benefit scheme on death?
Okay, on death in a defined benefit scheme, assuming there is a spousal benefit that's available within the scheme, your spouse would receive a percentage of your annual income. So in that instance, typically these days it's 50%. It might be more, it might be less, but typically it would be 50%.
So if I have a fund of 500,000 and Norma knocks me off, I have she would be entitled to potentially 50% of my annual income. Let's assume that was, for argument's sake, 50,000 a year. She suddenly gets to 25,000 a year. What happens if she dies then?
Well, in the DB scheme, there is the future benefit would die with your spouse. In a DC scheme, the entire amount or the entire value of your pension pot then will be passed into your estate.
Oh, okay.
So you'd have your family members or whoever you decide to be your beneficiary would receive the benefit of that. That's where when your circumstances, whether you're married and you have children, it really does influence the decision, because if you're married and you have children and you don't want all your hard-earned income that you've been obtaining over the course of your career to provide that income in retirement, and then when you die or your wife dies, then it dies with you. Whereas in a personal arrangement, it doesn't matter, I mean, not that you wouldn't be missed in the world, that's not what I'm saying, but the benefit, like the entire value of what you have left in your pension pot would be passed to whoever you choose to pass it to. It will be subject to obviously tax, and that will depend on the relationship of that individual to you, but more often than not, it will be a child that you're leaving it to. So again, it would just be if they come under the standard income tax and inheritance tax rules.
Okay. There was another question that someone emailed in. I've actually responded to it. So I'm not sure who actually asked this one, but they did say, please explain exit fees from defined benefit schemes. Now, I'm not sure of what exactly they mean, because typically there isn't an exit fee It may be just they may be just confused in relation to exit fees from retirement bonds. Not sure, but maybe if they want to email us in on that one, we can look at that a little bit more for them. And the other question again that I replied to was, can you take 1.5 times final salary from a buyout bond at 50 instead of the 25%? The answer is, assuming you full service completed by the time it goes into the retirement bond, then yes, you could, but it does depend on the actual service. And typically what we find is that people who are looking to take the bond at 50 don't have full service completed. And so the 25% option does typically work out better in that situation.
Yeah.
Yeah, that was kind of all the questions that had come in. Actually, sorry, there's another one. So in relation to members, oh, sorry, I think this is the one to do with the exit tax. It's in relation to members changing employers who have a DC scheme only. Sorry, I don't understand that question. So maybe if the person wants to come back to me on that one, if they want to email us directly in on so to either adrian@oaktreefinancial.ie or tracy@oaktreefinancial.ie, we might be able to answer that a little bit better for them.
Yeah, I have to say, I've never come across where there has been any exit penalties applied to a member when they leave a scheme. So it just would defeat the purpose of it, because bear in mind, with these schemes, the employer bears the cost of the provision of it.
Yeah.
So yeah, it would be very unusual. So yeah, please do, yeah, contact us and just provide us more information, because it would be interesting to try and figure out what it is you're specifically referring to.
Yeah. Yeah, I think that is that's all the questions that have come in. So if nobody else has any questions, we might leave it there. Tracy, if you wanted to put up our contact details there as well.
Oh, I'm sorry. I thought I was on that page. It's...
So if anyone does have any more questions or anything like that, if they want to contact us, please feel free to contact us. Adrian, our guy in marketing, is probably going to be sending this out to people as well. So if there is any more questions, you'll be able to contact us as well in relation to that. Other than that, thanks very much, Tracy.
Yeah, no, thank you, and thank you to everybody who attended. I do hope this has been beneficial for you. Yeah, and thank you for your time.
Great. Thanks
okay,
again.
take care.
Bye.
Bye.